Hello and welcome to another trades and tutorials video. If you've been watching these videos recently, then you know I've been talking a fair amount about the opening range and buying low. So in this video, I'm going to show you what happens when, well, it doesn't quite work out, and when you get stopped out and then you get back in and then it still doesn't work out. You know, sometimes that happens, but Goldman, as you see on my screen right now, was a really good example of a tough day in the market, a great setup, I thought, on the daily. I still think, and buying it low just didn't work out. But there were a bunch of different trading tactics in here that I wanted to share with you. But first, if you're not familiar with how to get this video in HD, use the little settings button down here in the lower right, and you can change the setting to HD, then stop and start it, and it'll be a whole lot clearer. Also, if you're just finding us for the first time and you're finding this out on YouTube, make sure you check out marketgauge.com/tutorials because there's a lot more information at MarketGauge as well. So let's dive into Goldman. If you're not familiar with the opening range and this is the first time you're seeing this, you might want to look back at the last couple videos. They still should be there. And if you're on trades and tutorials, I'm sorry, we only show the last 5. So when these come out, make sure you see them. But I think you can still see some of the other ones. So here's the deal. The daily chart here in Goldman going into this red day. So the red day is the day I'm talking about. But going into that red day, we have a really good daily pattern, and I'm going to call it good because Goldman has broken out and it's just retracing back to a natural area of support. More importantly, the recent price action had just broken below the support, come back in, and then followed through. All this had happened on a day when the SPYs, the S&P 500, had an inside day down here, so it didn't even take out the high. So Goldman had some good relative strength, and so I wanted to find an opportunity if it presented itself to get into Goldman. Furthermore, and you learn this in the other videos or the webinar. Maybe I'll put a link to that below the video. You learn that this was a really important level to focus on. And so that was going to be my focus. And so that level is around this high, the 197.60. And so if Goldman puts in an opening range reversal around that area, I want to be involved. Now, here's what it looks like on a 5-minute chart. So on this chart, I have labeled the 30-minute opening range low, so the low of the first 30 minutes, and the high of the first 30 minutes, which isn't really going to come into play today. You can also see the low of the prior day is down here, and the high of the prior day is up here. No surprise that the 30-minute high lines up with the prior day's high. That's a frequent occurrence. When that happens, you want to pay extra attention to it. All right, so how does this line up? Well, the 30-minute opening range low actually lines up at around 197.50. It was 197.60 area that I said I'd be focused on. Look, Goldman's got an average range of probably about $3. If my points are off by 10 or 20 cents on that particular type of range, I'm going to call it a good match. And then what happens? We put in the opening range low, and we do it on a kind of a cascading effect in Goldman. Now I have the SPYs down here below, so you can see that the SPYs kind of did the same exact thing. And then we got the pattern that we're looking for, the reversal pattern, right? That's in the webinar, it's in the prior videos as well. Close higher than the prior day bar, and we even got some follow through. So I bought it. All right, now I bought it because I like the big picture. I also liked the fact that the SPYs were trying to do the same thing. Now that said, the SPYs were not in a good technical setup in terms of a pattern to want to trade the opening range reversal. Okay, there's a negative daily pattern. I knew that this was a little risky. I put my stop underneath the low of the day. As it turns out, I had my stop at 196.67. And unfortunately, I didn't use our time confirm that we teach you in the AM Trader course because I wasn't going to be sitting in front of the screen focused on it. If I had done that, I wouldn't have gotten stopped out, but I did, and I got stopped out with the low of the day at 197.64, 3 cents below my stop. Now, I don't have a formal formula for this, but if I get stopped out by just a few cents and the market immediately reverses, and then it gives me another entry, which is exactly what happened here, right? So if I had not bought it here and I saw this pattern, I would have liked it there too. So what did I do? When it followed through, I bought it here. I got back in and I put my stop. Now this time I put my stop not below the low of the day because at this point I knew that the day wasn't necessarily going well for the market. Even though the market was also picking up, the IWMs were not back above their opening range. So the analysis of intraday opening range on the overall market was still quite negative at this point. So I wanted to risk less, but I didn't want to miss this opportunity. So how did I do it? I put my stop below this level right here. Okay, now it's not a great stop, but it's just a quick hit to get back in the event that I just get stopped out by a few cents. All right, now looked like I was going to be all right and it was going to take off. Now what should happen on a opening range reversal is that if the market does exactly this, right, breaks down and then comes back up and then breaks above this swing, and this yellow line, by the way, is the floor trader pivot. I'm not going to go into the importance of that in this particular video, but that is a really important level for the markets in general. So I like to have it on my charts. We have patterns that we look at around it. Floor trader pivot, common calculation. You can find it at marketgauge.com / or marketgauge.com in the resources area in the glossary if you don't know what it is. Definitely check it out, have it on your charts. As you can see today, this is a key swing area for the market, and that's not uncommon. And so that also played into my trade. So I got in through this level, and at that point, I really want it to break above this swing high, because as I was just saying, when the market comes down, bounces, makes a new low on the day, the next level you really are looking for it to break above is that prior swing when you've got it nice and clean this way. Once it breaks that prior swing, it really should not come back down below it. All right, if the market is strong, it won't come back down below it. So this provided a great opportunity for me to now move my stop up after this rally right here. I could move my stop up. Now, technically, I probably also could have taken a day trading profit right up here based on our parameters, but I was really looking to get into this thing as a swing trade, which is why I was so aggressive about not wanting to miss it after it had, basically held up and was respecting points that I was expecting to respect. That said, you can see the day was not going well. So I was fighting an overall market that was bad and trying to buy low. As a result, after it rallied and bounced off this level once, I put my stop in at no loss. As it turned out, I got ticked out right here, but in the end, it didn't really matter because it was just a plain bad day in the market. So just to review, there's a couple things and a couple important points here. First of all, this was a really good looking low pattern. I didn't even focus on the fact that you had the biggest volume bar of the day on the follow through bar. So I would do this again in a second. Unfortunately, I got stopped out right at the lows. When I get stopped out right at the lows like that and get an immediate pattern, I will often get back in. I I put my stop really tight because the market was not a good market. If the market had been a better setup, general market, I probably would have risked the whole trade again. And then finally, when Goldman did start off on the right foot, but then put in a pattern that suggested it was weak, just like the market, I just took my no loss stop. And eventually, what I wind up with is here 2 shots at a great looking daily chart, and I only lost on 1 trade. But I can't tell you how many times using this technique of once you get stopped out, getting right back in if you get the pattern again, but oftentimes you will on a good stock, and have the thing take off, and then I don't miss the trade. All right, so hope that helps. And if some of the stuff in this video didn't quite make sense because you haven't watched the other videos, I encourage you to go back and watch the other ones, or there may even be a link under this to learn more. So hope that helps. Have a great day.